Everybody. Welcome back for our next to last installment of the Financial Aid Atlas series. We are going to get started in just a moment here. We'll let everybody a second just to get into the room, and then we'll start with the presentation. So hang tight for just a minute. All right, 7 o'clock on the dot. Let's get it going. As always, my name is Zach Sawyer, our Assistant Director of Admissions at Maine Maritime. With me, as always, is Ryan French, our Director of Financial Aid. We are going into a second portion of our loan conversation tonight. We're going to be doing a little bit more conversation about rates, terms, conditions, and timelines tonight. As always, the session will be recorded. If you have any questions throughout the evening, please put them into the YouTube chat. I'll be monitoring that throughout the evening, and we'll get to your questions at the end, either live or I'll try to answer them as I can as we go along. It's been a great journey. This will be our last informational session. We do have one more scheduled webinar, and that's going to be a recap and a giant Q&A forum session. So if you have any last minute questions that pop up between now and then, please join us for our last session in 3 weeks' time. Same place, same time, Wednesday at 7 p.m. And without any further ado, I'm going to let Ryan take it away with our deeper dive into student loans.
Awesome. Thank you, Zach. Thanks for being here again. Thank you, everybody, for joining us tonight. Thanks for sticking with us. If this is your first time here, as always, welcome. We've got a ton of content out there, so feel free to go through and watch all of our other videos. I'll probably be referencing some of those tonight. If you've been with us the whole time, thanks for coming back. Hopefully you get some information out of this, and please feel free to throw your questions in. We're going to do a deeper dive on loans tonight. We talked about loans in the most recent episode, kind of did a bit of an overview. I'm going to go over some of that stuff just quickly as a review before we get going. But please, if questions come up, throw them in the chat, and we'll just get going here. So on the last episode, we started the conversation about loans. We talked about why borrowing matters. We talked about what types of loans there are out there. We talked about how to figure out, what loan amount you might want or need. And then we talked about how to find private loans, where to look for them, how to apply for them, things like that. The stats that are up there are the stats from last week as well. That national stat, 61% of graduates who came out of an undergraduate program in the United States borrowed some type of loan. So more than half of students borrow something while they're enrolled in school. Here at MMA, our number this last year was 57%, so pretty close to the national average, slightly less. That second stat is an MMA stat that is 2%, less than 2% default rate. And we went over what that meant in the last episode too, but basically that means that less than 2% of the people who have borrowed loans while they've been enrolled at Maine Maritime Academy have not been able to pay those loans back. So the vast majority of students are in a position to make those payments. And the reason for that, that we also talked about a few times in the last episode and previous episodes, are we've got a high job placement rate, 95% in 90 days, I think, is one of the more recent stats. And then we have a high return on investment. So, students are graduating from Maine Maritime Academy with high-paying jobs, high rate of job placement, and are able to repay loans. So that's why our default rate is so low. When you compare it to the national average, which this last year I think was 7%, that doesn't seem like a huge jump, but that's a lot of students that are unable to, make their loan payments. And it's important to remember that here at Maine Maritime Academy, that is less common. So why borrowing matters? Real quick review. It's an investment in your future. It's giving you access to these opportunities in school, whether you come here or go to any other school. A lot of people out there aren't in a position to pay for the cost of their education, out of pocket, maybe aren't getting all of the scholarships that, other people are getting or that they were hoping that they were getting, and they wind up having to borrow a loan. But it's an investment and it gives you a little bit more financial flexibility when you're in school. So you can pay your bill and potentially have, some funds available. Um, and then also it does help you build your credit. And it sort of develops some financial responsibility too for people who are borrowing. They graduate and they're able to, be getting their mortgages and getting their car loans and repaying those and very familiar with the process, and that can be really helpful. Um, we talked about what different types of loans there are out there. We talked a lot about the federal programs, the direct student loans, and the plus loan programs. I'll kind of briefly go and like talk about those programs again tonight, but for the deep dive on those, you want to go back to that last episode. And we also talked about the big private lenders out there, some of the big private lender names out there, and where to find those loans as well. Um, and then we talked about calculating those loan amounts. So figuring out not only with the federal loan programs how much you're going to be eligible for and how it's going to show up and what it's going to look like, but also figuring out how much you may need to borrow. So when you start doing that math and figuring out what your budgeted costs are going to be, how much other financial aid you receive, you can do the math and figure out this is probably how much I'm going to need for a loan for the year. And then on the other end of that spectrum, what is the maximum amount that I can borrow, which is another question that I get often and is a good calculation to know as you're trying to figure out, do I need to cover some additional expenses? Can I do that? Does it make sense? Like I said, we talked about that in the last episode, so feel free to check that out and throw questions in if you got them too. And finally, we talked about finding private loans. So I mentioned Elm Select. That's a really great website out there that lets you compare some of the big name private lenders that we've seen students come in with. By no means is that an exhaustive list. So I highly encourage people who have relationships with local banks or they have a relationship with a credit union, check with your existing financial institutions, see if they do student loans. Some of them don't, a lot of them do. It's worth checking in there. And then also, there's a ton of other private lenders out there. So feel free to do your own research. Elm is just a really good tool to start looking at that stuff and comparing, some of the rates and terms that we're going to talk about tonight. So that's it for the review. Let's jump in. We're going to start the conversation with interest rates and loan terms. Just going to be some fun stuff to talk about. So it's really important as you are looking into loans, you're comparing loans, you're trying to decide whether you want to borrow. It's really important to understand what interest rates and what terms are out there, how they affect the loan that you are considering borrowing, and how it may potentially impact your financial future. So it's really good to know how to decipher those interest rates and loan terms that you might see on a loan acceptance if you went out and applied for a private student loan. So your interest rate, that's your cost of borrowing a loan. That's the rate that the lender tax on there. They say, yes, we will give you the money to pay for school, but we're going to charge you a little bit. Sometimes they call it like a rental fee on your money. So you get this money to pay for school, you pay a little rent to get it up front. So when we start talking about interest rates, some of the comparisons that you're going to be making, some are obvious. There's high interest rates, there's low interest rates. That's a pretty easy comparison to make between two different loans. But then there's also fixed and variable rates. So I wanted to quickly explain what that meant. Um, the fixed rate, the lender says, yes, you can have a loan. We're going to give you a fixed rate of 6%. That means they're going to be charging you 6% per year on the amount of money that you've borrowed. And the entire time you have that loan, whether you pay it off in 2 years or you hold on to it and pay it slowly over 15 years, it's always going to be accruing interest per year at that 6% rate. Um, that's a fixed rate. A variable rate means that over time, it can be yearly, it could be every couple of years, it could be every quarter. The lender might decide that your interest rate is changing. And usually it's because it's tied to some other indicator out there. A lot of times they use something called the Fed rate. You can look it up. They usually post it right on the internet, available for everybody to see. Um, and the federal government sets a rate, and a lot of lenders out there will tie their variable rate to that federal rate. And the federal rate can stay the same for months and then jump and drop all over the place. So the reason it's important to think about that is because over time, one of those choices may make more or less sense. So a fixed rate can be really helpful because you know what to expect. You can plan ahead. You can plan down the line. But a variable rate, potentially, uh, you could be getting a lower interest rate over time with a variable rate, potentially. You could also be running the risk of having that higher interest rate over time. um, it becomes less of a comparison, like as you're thinking about all of this stuff. And we talked about that return on investment for students. I have so many students here who graduate and they've paid off their loans in a year or two. Maybe 5 years they pay off these loans after they've graduated. So your interest rate doesn't, I mean, you want to go with the lowest rate, but whether it's fixed or variable doesn't matter as much. Where those decisions really, really matter is over time. So if you are planning on doing a slow repayment, or maybe we're not talking about student loans, we're talking about your mortgage over 30 years, that can be really, really impactful. The variable versus fixed rate, it can be a really big decision. It's less important, I think, for a lot of our students who just are looking for whatever that lowest interest rate is, the lowest cost of borrowing that money, which really does make a lot of sense when you look at it that way. But it can be a really important decision to make too. So if you have questions about that, that's what we're here for. So as you're out there looking at private loans, you're comparing two lenders. You say, this one's offering me fixed rate, this one's offering me variable, or this is this particular rate and term. And those are things that we can help you look through. Actually, Zach and I both worked in private lending before we came into higher education. So, we may not be experts, but we are used to looking at interest rates and loans and stuff. So I'm very happy to go over that stuff with you if you have any questions as you're, looking into or starting this whole process. The other important thing are the loan terms. So term, when we talk about a loan term, a lot of times that really, for most people means how long you have to repay the loan. So your term is that duration, that period of time. But there's also terms like contract terms that are associated with your loan. And I list a few of them there, those protections, repayment options, repayment duration. Those are all things that can be very different between different lenders, between different loans from the same lender. They may have different terms. So it's really important to understand that, in some cases, you may not just be looking at the interest rate. You want to look at some of those terms as well. So the first one up there, protections. Some of the lenders out there they offer a lot of borrower protections. Some do not. Um, a lot of the private student lenders do offer some of the protections that I'm going to mention. One of them is deferment. That's a big one. Deferment means you do not have to make payments. You get to defer your payments while you're enrolled in school. Now, some lenders will offer that and say, yep, you don't have to make payments, and that's the only option. Some lenders might say, well, yes, you don't have to make payments, but if you do make a payment, a small payment, or you're making like full monthly loan payments while you're enrolled in school, we'll offer you a lower interest rate. Now, most students aren't really in a position to be making payments while they're enrolled in school. But if your family is in the financial position to do that, or you've planned ahead to do those sorts of things, that can be really beneficial to have that lower interest rate. So it's an important thing to look at and think about. And then the repayment options, the repayment duration, those kind of go hand in hand. Like deferment is a repayment option, really, but it's also a protection. Some of the other protections out there are things like forbearance. So if you've graduated, maybe you're in a position where you're unable to work for whatever reason, you can't make your monthly payment that month. A lot of lenders out there will offer forbearance as an option. You can call the lender and say, "Hey, I can't make my payment this month. Is it okay if we, push this off for a little bit?" and many of them will offer some level of forbearance. So they may say, yeah, you're good. You don't have to make payments for the next 3 months. But maybe you have to offer up some documentation or something like that. So those are things, those are benefits that are worth looking into and checking out, seeing what your lender is offering. So if you're comparing two loans from two different lenders and the rates are the same, what are some of the other benefits that come with that loan? As we start looking at like the repayment options, that's when we're talking about, in some cases, we're talking about that repayment duration. So one of the options is to pay it off fast, you pay it off slow. You can also have what's called a standard repayment plan, meaning whatever the term is that they're offering, you know, if it's a 10-year term, which is pretty standard, you're just paying it off over 10 years. You're not making any additional payments as you go. Then that's standard repayment. Extended repayment would be pushing a little further. A lot of lenders, they'll go up to 15, I think, and they may have some borrower protections or repayment options, you know, within whatever you've chosen. So even if you choose a 10-year term, you start making your payments, you decide, you know what, I actually would rather pay over a longer period of time, because in a lot of cases that means you're paying less money per month if you spread it out. You know, they may say that you're allowed to do that. Some lenders will not let you extend your repayment once you've locked yourself in. So that's another thing to think about as well. It really is, again, I don't want to like necessarily oversell and convince a bunch of people to borrow money that they don't need to borrow, but students here really are set up to make these payments. So a lot of these things um, aren't really, you know, top of mind for a lot of students that graduate. I wish it was more so top of mind as they start looking for these loans, because you know it can be really beneficial. You can play the game a little bit and get, you know, better terms, better rates if you're in the position to do so, and they can be really beneficial once you graduate. Many students don't really care because they're not worried about making payments after they graduate. They're not looking at what the rate or the term is going to be necessarily, or maybe they're just focused on their rate. So um, it's important to know this stuff. I think it's a really good education, but at the same time, you know, if you want to just look at the rate, pick the lowest one, get the loan, you are also allowed to do that. So um, yeah, we talked briefly about that repayment duration. It can be short, it can be long. Most of the lenders out there, they let you pay it off as quickly as you want to. So even if you're fixed in at a 10-year repayment, if you want to pay it off faster, there's no problem. Some lenders out there do have a little clause in there. It's called a prepayment penalty, which means you pay it off early, they charge you, or you get charged some kind of penalty if you pay it off earlier than what you've been scheduled. Most student lenders don't, but that's an important thing to look into and see. I did want to mention or put in there some of the, you know, rates. You've seen them at this point. The rates up there for the federal and private student loans. The federal student loan rate, you'll see the plus and the student loan rates both have an asterisk next to them. That's because those are projected. The federal government still has not determined what the interest rates are going to be for those loans yet. I know what they are for 23, 24. It might be the same. It may change. We're not really sure yet. But that is the projected rate based on just kind of the direction things have been going. They're suspecting somewhere around 6% for the student loans, 8.6% for the plus loans. The private student loans are a really wide range, which can be up to the lender, you know, whatever they're looking at for some of the application process, the credit things that they're looking at, which we're going to talk a little bit about on the next slide. You know, it can have a big swing on that interest rate. I haven't seen a lot of 17% out there, but I've seen some pretty high ones. And I haven't seen a ton of 4% out there, although I would say I think I've seen more on the lower end than on the higher end in the last couple of years. But generally, if you're looking at private loans, one of the pieces of advice that I offer to people is to kind of compare it to that plus loan rate, because it tends to be somewhere in the middle. So plus loan rate is somewhere between 8.5 and 5, or 8.5 and 9%. If you've got a private loan that's coming in, you know, they're offering you a rate below that, that's probably a pretty good bet. If they're offering you an interest rate significantly above that 9%, you may want to reassess, you may want to, continue shopping around and see what else you might be offered out there. And then if you're getting offered like consistently 12% or above, like definitely come talk to me, because we do have, I mentioned in the last episode, we have an institutional loan program here. But then also, maybe we look into that plus loan as an option if you're not having success finding those private loans at a reasonable rate. So I briefly mentioned credit. Credit is important as you're applying for private loans. It does not matter at all for the student loans. They don't care what your credit is. You don't have to apply really for those federal direct student loans. Your FAFSA is your application. They don't run a credit check. It does get reported to credit agencies. So if you borrow those loans, there are some credit benefits over time. It establishes history, and you do have to pay those loans back. But they don't check your credit to see if you're worthy of a loan before they offer one to you. For the plus loans and the private loans out there, they are going to run your credit as a student, and any parents who are thinking about doing the plus loan, they're going to check your credit as well. If the student has someone co-signing on a loan, a parent, grandparent, family friend, something like that, that person's credit is also going to be checked. So as you are looking at those loan applications, where your credit is, it will impact what you are offered and whether or not you're approved for loans. So if you have good credit, meaning maybe you've had a couple loans in the past, or you've had a credit card, you've made regular payments on those things, you have established, some history with other lenders, and you have whatever the good credit score is, you will probably be offered lower interest rates from lenders. You will have a higher odds of application approval for loans. And then you'll get more flexibility. And by that, I mean, you will be allowed to borrow more money. With student loans, the loan amount is usually tied to, what your costs are at school. They're a little bit more flexible with that. But if you've got significantly bad credit, they may cap. They may say this is the maximum amount that we're going to let you borrow, even if, even if your costs are higher than that. One of the benefits of borrowing loans, whether they're your federal loans or your private loans or whatever, is that it lets you build credit. So a lot of students who are coming out of high school, they're going into college as freshmen, they don't have any credit history. And so borrowing these loans builds that credit, as long as when the loan goes into repayment, you are making those payments on time. You are keeping balances low, meaning if you are going out and getting a credit card, you're not, racking up that credit card balance. And you're monitoring your credit report. I mean, it's been a big deal over these last, many years now, with a lot of fraud out there, a lot of identity theft. So it's really important to pay attention to your credit report. There's a few free places that you can check that out. I wish I had written down what they are, but there are places where you can monitor your report. It's a good idea. It's pretty important. I personally use Credit Karma. I don't want to necessarily like plug anybody, but there's plenty of places that you can go. There's free places that you can go to get that information. And as you build that credit, as you make your payments, as you keep those maybe a credit card balance low, or you're making payments on your loan, you are establishing credit. So the end result for a student who's graduating from college and they've borrowed loans is that they have established credit history. So those students, when they go out into the world and they're looking at buying a house or buying a car, they have established that they are uh, a, a worthy borrower. They have the ability to now go and get car loans, get mortgages at those lower interest rates with a higher rate of approval and more flexibility with all of the loan terms, and flexibility with the amounts of money that they're able to borrow. So that's kind of the long and short, I guess, of credit. It can be really helpful to have good credit. It can be really harmful to have bad credit. As we start looking at, private loan applications, it can be very impactful. So one important thing to think about is with the private student lenders, you could potentially, depending on your credit situation, depending on whether or not you can find a cosigner as a student, you may get denied for loans. Like they may not offer you a loan. Now, some lenders have more relaxed credit standards than others, so that's why it's important to shop around because, two similar lenders may offer you very different loans, very different interest rates, very different loan terms. One may approve you, one may deny you. So it is important to shop around. Um, and then as we look at some of the federal stuff, if you were considering doing or your family was considering doing the plus loan, the federal plus loan program, that's a loan where the parent is the borrower, the parent's credit is being checked. If you are a parent who has really good credit, or even frankly kind of subpar credit, you're probably going to get approved for that loan. Um, and so it can be really helpful because the federal government tends to have slightly lower credit standards as they start looking at that stuff. But on the flip side, if you know for a fact you just filed bankruptcy in the last year, or you know for a fact that there's no way you're going to get approved for a loan, the plus loan, as an example, is one where if a parent applies for the plus loan and gets denied, the student is then allowed to borrow more out of the federal student loans that are on offer. Not much more. As a freshman and sophomore, they get to borrow an extra 4,000, and as a junior or senior, they get to borrow an extra 5,000. But sometimes that's all you need. That makes the difference, or it helps make the difference with a couple other financial aid options. If you're in a situation like that, you don't know if you're going to get approved, or you've been applying and you've been denied, definitely reach out to me. That's what I'm here for. That's what I like to help out with, and we can figure it out. But as you are looking at that stuff, I just don't want you to be discouraged. Like if you get denied for a loan, that doesn't mean just give up because there's definitely other lenders out there, and it's worth checking around to see what options you may have. But always as a fallback, come talk to the financial aid office. That's what we're here to do. All right, so we're almost done here. Actually, I want to make sure we leave plenty of time for questions if there are any questions out there. But I did want to talk about the sort of the life cycle of student loans here at Maine Maritime Academy and in general, even if you decide to go somewhere else. Um, the the whole process starts with a loan application. So typically, as we're looking at, hey Zach, your sound is not muted. Just FYI, so people can hear your crumpling back there. Um, So with the student loan life cycle, it kind of starts with the application process. A lot of families that I talk to, I encourage them to sort of cool their jets, start applying for loans in May. That's usually when we start finalizing some of the cost of attendance, some of the estimated financial aid out there. It's really, really, these can be really helpful things, but it's really important to prioritize the free money first. So let's spend time right now, while we're in April, and as we go into future academic years, up until April, May, really be focusing on private scholarships out there, getting all of that free money set up first. Then we can kind of get a good idea of here's our budget, here's our cost of attendance, here's what aid we're expecting to get. This is bottom line. This is what we need to cover, and that's when we can start having that conversation about loans. So like I said, applications typically May, June timeframe is when students are applying for loans, parents are applying for loans out there. During that process, you apply for a loan, you get approved, the lender will send a certification to the school. So they reach out to me, they say, hey, Joe just applied for a student loan. Is he enrolled at your school? That's the first question they ask. So I'm certifying enrollment in that process. They also ask, how much can he borrow? So I'm reporting what the student's cost of attendance is in some cases, and I'm reporting what their estimated financial aid is. So, the lender gets to do their own math and say, is this student really, able to borrow this amount of money that they've requested? And then I am also scheduling disbursements. Disbursements are, those days. Basically, it's a day when the money is actually being sent to the school from the lender. So I schedule that day as part of that process. Um, I'll talk a little bit about that in a second. Well, I can talk about it right now. Our own personal timeline, those bills go out in July for the fall semester, and then they'll go out in December for the spring semester. And then we schedule our disbursements, meaning you apply for a loan, you get approved, I certify it, I schedule your disbursements for the fall and the spring semester. So I highly encourage the students to borrow, or they plan to borrow for the full academic year, even if we really only have a bill for the fall. We can budget for the whole year. You borrow a loan for the full year. I schedule the disbursements for the September and January, basically the beginning of the fall, beginning of the spring semesters, and then everything else is like done. Once that's done, it's done. Like you can make changes if we need to, and that can be really helpful if you decide you want to borrow a little extra in the fall, borrow a little less in the spring. Maybe I can make adjustments up until basically up until those disbursement dates. Um, but that's really the whole life cycle as it exists here at Maine Maritime Academy. For you, there's one extra step as a student or potentially as a parent, and that's repayment. So we don't experience that as much here in the financial aid office, like talking about the repayment stuff necessarily, because we're really looking at getting the loans, certified, and getting the money here to help you pay for college. But then eventually you are going to have to pay it back. So repayment becomes a really important part of that process as well, for you, the student, or you, the parent. Um, I put two little quoted words up there that I wanted to define real quick, and that's grace period and less than full time. So, grace period is typically a period of time after you've ended your enrollment. So, in the best circumstances, you have graduated from a maritime academy. You're not here anymore. There is a grace period, usually 3 months, sometimes 6 months, where you don't have to make any payments, um, and then they will start making payments after about 6 months after you've started graduating. And like I said, sometimes it's three. There is another circumstance where repayment can begin if you have deferred payments while you're enrolled in school, and that is if you have either withdrawn from school, meaning you've dropped out, you've left, you've decided to take a semester off or a break or something. That is something that would kick off that grace period and start repayments. There is also for federal loans and some private loans, if you drop below half time, meaning um, in most cases it's below halftime. So you've gone from, let's say, 12 credits a semester to 5 credits a semester. For the federal government and for some private lenders, they say, nope, that student is not enrolled in school. Not really, and they have to start making payments on their loans. So it can be really beneficial to, if you are planning on taking a light semester, and I say this to a lot of seniors who are here. They've covered a lot of their class requirements, and maybe they're taking a light semester near the end in some cases. Um, if you drop below 6 credits in a semester, you will be required to start making payments on your loans. So it can be sometimes beneficial to take that halftime minimum. I say less than halftime though. I mean, I'm sorry. I say less than full time though, because it's important to just pay attention. There are lenders out there that will say if you're not enrolled full time, meaning you're enrolled in 11 credits instead of 12, you have to start making payments on your loans. Not many lenders do that, but it's an important thing to pay attention to and look out for. And really, if you've pulled anything from this webinar at all, it's just really important to pay attention. It's important to pay attention to the interest rates and the terms, and it's really important to stay in touch with the lenders. Like as you are, going through school, you're maybe applying for loans, you're getting money dispersed, maybe you're making payments, maybe you're not. It's just important to pay attention to what your loan balance is, who your lender is, what the best contact information is for them, and make sure that your contact information is on file with the lender and up to date, so that if they need to send you an update or they're trying to get in touch with you, that they can, because that all rolls back into that credit history and good and bad credit conversation. Like, just being in touch with your lender, being familiar with and knowing how to navigate all of this stuff, pay attention to all of it, respond to, your lender reaching out and trying to call you on the phone or send you an email about something. It's a really important thing, and it can be helpful over time, to familiarize yourself with those things so that after you graduate and you are back into repayment and you do need to take a month off and do a forbearance or something like that, you know who to call, and what numbers to look out for, and then you're set up so as you are, you know buying a house and getting a mortgage or getting a car loan, like, you already know all of this stuff, you're ready to go. So that's my whole thing on student loans. I definitely want to make sure you guys are aware of the additional resources out there. Um, there's all of our phone numbers and emails here in the financial aid office. I've also included Zach's contact information in there as well, and some of the information for our billing office. Diane and Casey up there are really great. If you have questions about how we bill or what that looks like, they can be really great resources. I can answer a lot of questions too, but they tend to be the best people to talk to. So I'm going to open it up to questions. If there are any questions out there, feel free to throw them in the chat. If you don't have any questions, that's awesome. I know I talked a lot and about a lot of things, so feel free to ask them if you got them.
And in the interim, I would like to apologize. I was eating a gummy bear. I got hungry. So there was some crinkling. I apologize
I
if you
knew it.
heard any of that. But I'm pretty sure, Ryan, only you can hear that on your monitor because it's not going out live. But all the
Are
same,
you are you serious?
yeah, I apologize
I'm
for
sorry,
throwing
everybody.
you off your game. I feel bad.
I'm
But I know that tonight was a lot of review. Our previous session was really looking at the sources and some of the functions of borrowing for college. And this is a little bit more about the technical terms that you're going to see as you go through that process. So we did answer a lot of questions on the last episode. If this is really just getting you a little bit deeper into it, maybe more in the weeds potentially, but definitely things that, like Ryan mentioned, to be aware of. So if nobody has any questions tonight, that's okay. We understand. We want you to save those questions for our big session on the next one, which, Ryan, if you want to switch over to the next slide, you can put our data for our final episode of the year. So we
Yeah.
do have our Q&A forum coming up. It's a total recap. We're going to answer your questions. We're going to talk about some of the key insights that we pulled out of this year's session. It's been a really, really great year so far for this Financial Aid Atlas program. I would say a much larger success as far as what we've heard in feedback from you guys as you've come and visited us on campus or sent us emails or through the phone calls that we've gotten from our previous session, which was, honestly, way too dense. Um, this has been a lot more fun for us to produce and to put forward to you guys, and I feel like it's reaching those that need the help along the way. Um, if you continue to have questions along the way, obviously we're still here for you, especially through the summer as you're trying to, fit the last couple of pieces together. And one thing that I want to throw out there, and Ryan, you can back me up on this if you feel it's necessary, is that we get a lot of people who are still calling us and feel like they're behind the ball. We would like to remove that stigma. You are not behind the ball at this point. You still have plenty of time to get everything in line. And quite honestly, the FAFSA setbacks didn't get anybody into a great position to start the process. So we're now fully getting all that correct, Ryan. Things are coming in from the federal government side. We are processing them as quickly as we can, and we're going to get that back to you so you can plan accordingly. But no one's behind the ball at this point. I want to stress that.
Yeah, I will echo that sentiment as well, Zach, because I definitely have. I talked to a family today who came in and felt like they'd really dropped the ball on this whole process. And honestly, even if the federal government hadn't delayed the FAFSA as long as they did, it is still not too late. There's a lot of deadlines out there that get thrown around. Maine Maritime Academy has its own deadlines that exist, but right now in April, it is not too late. It's not too late to do the FAFSA. It's not too late to get some scholarships. It's not too late to go out and find a private loan and get all of this stuff together. That's what we're here to help you with. So if you feel like you're struggling with that or you feel stressed out about that process, like, definitely come and talk to me. That's what I'm here for. That's what that in a little for a little bit. That's what Zach's here for. But primarily, that's what the financial aid office is here to help you with. So
I'm really good at
myself,
forwarding phone calls down to Ryan's office, so
yeah,
call me first if you need to. I'm happy to help.
I'm here, Angela is here, Jeff is here. We are all resources for you as you are trying to navigate this whole process. Hopefully, this webinar series has helped with that a little bit, helped you navigate some of this stuff, given you the information that you need. But we are also here. The actual articles who can just sit here and help you through the process. That's what we're here to do. So
I've known Ryan for a few years now, and I can tell you right now he's a big nerd, and he has researched all the answers, so he can definitely help out. Um, and keying into some of the things he mentioned about our background, we were in loans, so we're more familiar, a little bit maybe more comfortable with the terms and the things that we're looking at as we have these discussions. And as we do with this series, we'll break it down for you as much as we need to help you feel like you're on top of it. Or Ryan and his team will. I will sit by idly and smile in the background, um, which is what I do now. It's great. It's the best job in the world. But it looks like we don't have very many questions tonight, and that's okay. Like I mentioned, this was really just a little bit more of a drill down on some previously conversated topics. And we can look forward to seeing you all again in 3 weeks' time, May 15th. It's a Wednesday, 7 p.m., right back here on YouTube. Bring your questions. Hopefully, we get a lot of them at that point so that we're not just staring at dead space. So come with questions prepared. We'll have some that we think that are frequent flyers. Maybe we can throw out there some things that we've heard along the way that we get a lot of, so we can clarify for those who haven't been brave enough to raise a hand. But definitely use this as resources going forward. And so for me, thank you guys. Love having you back here. Love seeing the faces come on campus and talk to us about this series. It's always a little bit funny when those interactions occur, but we're glad that these resources are out there and that they're being found helpful.
yeah, thank you all so much. Thanks for hanging out with us tonight. Reach out if you didn't, want to ask a question in the chat. That's fine. Send me an email. Reach out. Give me a phone call. Come by the office sometime if you're on campus. That's what we're here for. Thanks for being with us, and we'll see you next month.
See you guys.